Banks are financial institutions that serve as intermediaries between individuals, businesses, and governments in the economy. They play a pivotal role in facilitating economic transactions, managing funds, and promoting economic growth. Let's dive into how banks work and their various functions. 1. Core functions of banks. A. Accepting deposits. Banks provide a safe place for individuals and businesses to deposit their money. These deposits can be in the form of savings accounts, checking accounts, or fixed-term deposit certificates of deposit, or CDs. Customers can access their funds as needed while earning interest on their deposits. B. Providing loans. One of the primary functions of banks is lending money to individuals and businesses. Banks generate revenue by charging interest on loans, such as personal loans, mortgages, business loans, and credit cards. This process stimulates economic activity by making capital available for various purposes. C. Payment processing. Banks facilitate the transfer of money between individuals and entities. This includes processing checks, electronic funds transfers (EFTs), wire transfers, and providing payment cards like debit and credit cards. The banking system ensures the safe and efficient transfer of funds. 2. Types of banks. Commercial banks. Commercial banks serve both individuals and businesses. They offer a wide range of financial services, including checking and savings accounts, loans, and investment products. B. Investment banks. Investment banks focus on providing financial advisory services, underwriting securities, and facilitating mergers and acquisitions. They often work with corporations and governments to raise capital. C. Central banks. Central banks, such as the Federal Reserve in the United States or the European Central Bank, oversee monetary policy, regulate the banking industry, and control the money supply to maintain economic stability. D. Cooperative banks and credit unions. These institutions are owned by their members and often serve a specific community or group. They offer similar services to commercial banks, but with a focus on member benefits. 3. Bank operations. A. Reserves and fractional reserve banking. Banks are required to maintain a portion of their deposits as reserves. This system, known as fractional reserve banking, allows banks to create money by lending out a multiple of their reserves. This process plays a crucial role in the money supply and credit creation in the economy. B. Risk management. Banks engage in risk assessment and management to ensure the safety of customer deposits and the soundness of their operations. This involves evaluating credit risk, market risk, and operational risk. C. Interest rates. Banks influence interest rates by setting the rates they offer on deposits and charge on loans. Central banks can also adjust interest rates as part of their monetary policy to control inflation and promote economic growth. 4. Regulatory framework: banking regulations. Banks are subject to extensive regulatory oversight to ensure their stability and protect consumers. Regulatory bodies, such as the Office of the Comptroller of the Currency (OCC) in the United States, enforce rules related to capital adequacy, risk management, and consumer protection. B. Deposit insurance. Many countries have deposit insurance programs that guarantee a certain amount of deposits per account holder, providing confidence to customers that their funds are safe even if the bank encounters financial difficulties.